Multifamily outlook for 2022. In this video, I'll discuss the latest CoStar Predictions Report, specifically as it relates to the multifamily sector. Hi, my name is Duke Ong and I'm a multifamily syndicator with Tri-City Equity Group. We're going to dive into the top 14 predictions for 2022 for the multifamily market and the economy as a whole. Before we do that, make sure to like, subscribe, and turn on notifications. If you have any questions about investing in real estate, please reach out to me. I'll leave my contact info in the description below. Give me a call, shoot me a text, or send me an email, and I'd love to help. According to the BBC, over 9 billion doses of COVID vaccines have been administered in at least 197 countries in 2021. While scientists, researchers, and physicians demonstrated great progress in responding to the challenges posed by COVID-19, the virus continued to impact every corner of the planet. As a result, the global economy and markets demonstrated uneven signs of recovery. While select countries such as the US were able to ultimately regain pre-COVID economic activity, there's still uncertainty in the hardest hit sectors such as hospitality. Demand for warehouses exploded, while office leasing and occupancy remained subpar. 2022 seems to offer fresh promises on the long road towards a higher degree of normalcy, given the availability of vaccines and emerging therapeutics. Setbacks are inevitable in further loosening the pandemic's grip on cross-border economic activity. Even as many nations have demonstrated increased confidence in opening borders to international travelers, recent events suggest political leaders are willing to act quickly to reimpose restrictions in the face of actual health crises. Others, such as China, continue to maintain tight border controls and domestic restrictions under its zero-COVID policies. Nevertheless, while there are downside risks to the following predictions, it's reasonable to assume that many countries and municipalities with high levels of vaccination and controlled COVID-19 positivity rates should continue to demonstrate a desire to ease constraints as the next year unfolds. Beneficiaries of a more relaxed health framework include large, dense cities, along with demand for in-person retail experiences and the return of office workers. However, new challenges have emerged, such as inflation and supply chain bottlenecks, which present additional risks to consider, such as central banks' adjustments to monetary policy. Prediction 1. Employment to recover to pre-COVID levels. While the labor shortage will continue through 2022, I expect total employment to recover to pre-pandemic levels by the end of the year. The labor market still has a gap of 4.2 million jobs from its pre-COVID peak, after gaining 5.8 million jobs through the first 10 months of 2021. The jobs will not come easily, as the job opening and resignation rates are at or near all-time highs, while the unemployment rate is getting close to full employment levels. Increasing wages, along with pressure from what is likely to be an elevated inflation rate, will need to coax workers off the sidelines, especially for lower-income workers. Wages for the lowest quartile of earners have grown 5.1% in the past year, 1.5 percentage points above the national average, as industries like accommodation, entertainment, and warehousing struggle with job opening rates above 8%. COVID-19 is also still playing a role, as 7.5% of workers without a job cited COVID concerns or its lingering effects as a reason for not working. However, increasing numbers of households reported relying on debt and savings to meet household expenses, indicating that pressure is beginning to mount for some of the holdouts to begin returning to work and fill some of the 10 million current job openings. Prediction 2. The Fed will lift rates by the end of 2022. As the labor market recovers and inflation pressures last into 2022, I expect the Fed will raise rates from zero. The Federal Reserve has already announced a tapering of its bond buying program, which is expected to end in mid-2022. The chairman of the Fed, Jerome Powell, has said the Fed is willing to wait for the job market to return to full employment, something he said that was possible in 2022. Either way, the risk to the Fed funds rate here is to the upside, as inflation pressures have broadened and supply chain bottlenecks are unlikely to be resolved soon. The Fed is walking a tightrope as it moves away from an ultra-accommodative stance. Raising rates too quickly risks the labor market recovery, while too slowly will not do enough to tamp down the recent burst in inflation. The market is betting on multiple rate hikes, assigning an 83% chance of rates being above 50 basis points as of the middle of November. If inflation continues to accelerate, the timeline could be moved up further, as the Fed will need to show it is serious about keeping price growth in check, or risk its credibility going forward. Prediction 3. Inflation will decrease in the second half of 2022, though still high. Inflation will be lower in the second half of 22 than it was in 21, but it will remain well above the Fed target of 2%. Inflation has surprised many, including the Fed, with its strong drive to multi-decade highs, as supply chain problems mixed with surging demand created a perfect storm of upward pressure on prices. Inflation initially hit a few pandemic-related goods like transportation and energy, but the past few months of 2021 have seen particularly strong price growth and a broadening of the pressures to more consumer goods. Roughly 60% of component prices in PCE inflation grew by 5% or more in September, up from 25% at the beginning of the year. The Fed has remained dovish, despite the rapid acceleration, as it is looking for a fuller employment recovery. But it is being pushed towards action. That, along with the eventual resolution of some supply chain and labor shortage issues, should help take the bite off price pressures. None of these will happen overnight, so it is unlikely year-over-year inflation will return to its roughly 1.5 to 2.5% average by the end of 22. Barring an economic downturn, an unexpected shock, or for a more hawkish Federal Reserve, movements should be gradual. Prediction 4. 2022 will see continued GDP growth. The year 2022 will be the second fastest growing year for GDP since 2010. While there remains some difficulty in the economic prospects of the US, particularly around the supply of workers and goods, the expectation is that GDP will still experience strong growth in 22. Growth projections have receded somewhat from spring highs, as the Delta variant surge dampened optimism and the relatively low 2% GDP growth reading of the third quarter didn't help. There is a mix of forces working in opposite directions for the US economic recovery. Stimulus money, which supported strong GDP growth in the first half of 21, has mostly been spent. Despite the surge of goods consumption well above pre-pandemic levels, a regression to the mean is likely, which would dampen growth in 22. However, as the economy has opened in the wake of effective vaccines available to all, services spending has grown 5%, while goods spending growth has remained effectively flat since the beginning of the year. Services spending represents 2/3 of consumption, and recovery there should translate to a strong 22 growth number above what was experienced in the 2010s, barring unforeseen issues such as COVID variants. Prediction 5. Best case scenario, inventory growth returns by end of 22. Total business inventory levels relative to existing logistics supply will return to growth by the end of 22. The drag on inventory growth has been apparent as bottlenecks in supply chains have made it difficult for restocking to keep pace with demand since the second half of 2020. We expect most supply chain bottlenecks to be resolved towards the second half of 22, resulting in an improved ability for businesses to rebuild their stocks. The freight index, which measures the movement of goods in the US economy, has already recovered to pre-pandemic levels and is expected to continue to rise once bottlenecks ease. This inventory growth tailwind is expected to continue to strengthen demand for warehouse space toward the end of the year, keeping vacancies tight. Prediction 6. Dry powder to continue to favor North American commercial real estate strategies. Dry powder flowing to commercial real estate strategies, as tracked by Preqin, has continued to rise over the past decade, though since the pandemic there has been a divergence in flows to North American CRE strategies compared to the rest of the world. Dry powder for North American CRE investment stands at over $200 billion, and we expect that given the continued outperformance in the US economic recovery relative to other nations in 2022. Dry powder aimed at the US CRE strategies will continue to rise. The relatively healthy returns and inflation hedging capabilities of CRE are likely to continue to drive investors to the asset class, particularly in industrial and multifamily investment. Prediction 7. Cap rates will hold, but spread to 10-year Treasury will narrow. Cap rates should hold steady, but Fed rate hikes mixed with tapering asset purchases and higher inflation should push interest rates up, which will narrow the spread between the two. Currently, the spread between cap rates in the office, multifamily, and industrial sectors and the 10-year Treasury sit at 20-year averages, despite cap rates being quite low by historical standards. A tightening of those spreads does make real estate somewhat less attractive, as investors get less return above the risk-free rate. But real estate has an advantage over other asset types in a hyperinflation environment. Rents can move with inflation to some degree, especially in assets with high demand and shorter lease terms like multifamily and industrial, making them good inflation hedges. The data bears this out, especially for multifamily, where NOI growth typically tracks closely with inflation. That does not mean real estate will not see upward cap rate pressure, but shorter-term fluctuations have less effect on cap rates if expectations are for interest rates to remain relatively low for an extended period. Prediction 8. Gateway office price growth will lag as multifamily and industrial prices boom. While prices will grow across the board, Sunbelt markets and multifamily and industrial property types will continue to outperform. On the other hand, gateway markets and the office property type will still be in recovery mode as uncertainty still persists. Coastal gateway markets like New York and San Francisco have continued to experience low deal volume for office, where work-from-home issues loom largest and pricing discovery has been difficult. While it is expected there will be some more clarity around the work-from-home question, higher vacancy rates will put downward pressure on prices. On the multifamily side, Sunbelt markets like Tampa, Austin, and Phoenix have seen per-unit pricing respond to surging demand, with prices in the Sunbelt 30% above pre-pandemic levels. Price growth should decelerate in 2022, but with the Sunbelt markets expecting the majority of prime-age labor force growth, the region is still expected to outperform. That demographic growth will also help industrial pricing. Given the need for industrial space as e-commerce continues to dominate, strong pricing growth is expected independently of the market. Prediction 9. Tier 1 market volume share will rise. Tier 1 market share is on a long-term decline as the secondary markets grow and outperform, but the sharp downturn in the share that started in 2020 in the face of the pandemic should reverse course, such that the share at the end of 2022 ends above the share at the end of 2021. Tier 1 markets experienced much sharper declines in demand growth across property types as the pandemic took hold. That lack of growth made investors fear for the future of those markets. As the disruption from the pandemic faded somewhat, Tier 1 markets experienced a growth rebound. A return to a more normal growth pattern should mean a return to a more normal market share, hence a recovery in transaction volume share. Prediction 10. Apartment demand and rent will decrease. Apartment demand is unlikely to continue growing at the same pace as 2021, which will help cool off rents. The removal of federal stimulus and enhanced unemployment benefits, the retraction of the eviction moratorium, and a return to positive absorption in senior living facilities will all negatively impact apartment demand, though it is worth noting that protections for some tenants will likely remain in place in certain markets. Demographics for the renter segment remain reasonable for the foreseeable future, so this is not a suggestion that demand will fall apart completely in 22. However, the level of growth achieved in 21 is unlikely to be matched. Prediction 11. Construction input costs will continue falling. Supply chain issues are going to unwind slowly, but we expect that at the end of 22, construction inputs will be lower than they were at the end of 21. Softwood lumber leads the way in declines. Compared to January of 22, softwood lumber prices are still up by over 30%, but compared to October of 20, they are down by about 20%. Although demand for these materials should not taper too much and supply chains will not completely clear, I expect the extreme crunch of 21 to slack off in the 2022 and lessen input costs by a meaningful amount. Prediction 12. Workforce housing will remain tight. While much of the surge in raw demand in 21 flowed to A-class units, vacancies in B and C class tightened to new lows. Demand for these lower quality units and lower rent units is expected to hold up such that vacancies rise by less than 1/4 percentage point, if at all. Supply is limited in the lower end segment of the market, so while populations might grow, the cheaper available units generally do not. This suggests that there is a reservoir of demand for workforce housing, some perhaps living a little above their means in Class A units. Some might still be with their parents, and some in cramped roommate situations. If inventory were to become available, one of these reservoirs would likely plug the gap and keep workforce housing vacancies tight. Prediction 13. Growth markets outperform due to stronger demographics. Stronger demographics, favorable cost of living and doing business, and stronger employment growth in smaller markets will all weigh in on the performance of Tier 1 markets moving forward. As of 21 Q3, Tier 1 multifamily rent growth stood at 7.2%, while the rest of the national index markets were at 14.2%. Tier 1 markets have underperformed regarding employment growth due to smaller markets having more attractive costs for doing business, and in turn, business expansion. This ultimately has impacted multifamily demand. As a result, annual multifamily demand in Tier 1 markets has underperformed the rest of the national index markets, with Tier 1 net absorption at 1.4% of inventory, while the rest of the national index was at 2.6%. Going forward, Tier 1 rent growth is expected to underperform at 6.5% compared to 7.5% nationally, due to the stronger demographics and employment growth in other markets across the country. Prediction 14. Shift to suburbs and work from home continues larger unit outperformance. The increase in work from home and shift to the suburbs has prompted renters to prefer units with more space. This has benefited larger units and is expected to continue to do so moving forward. Annual demand as a share of inventory for larger units, 1 to 4 beds, stands at 2.9% as of 21 Q3, compared to 1.7% for studios. Although there has been an uptick in both multifamily demand and the number of workers returning to the office, 36% as of October, according to the Castle Systems data, work from home has had a permanent impact on the desire of renters to accommodate their space needs. In turn, many renters will continue to sacrifice their short commutes for more space. Moving forward, as work from home remains elevated compared to pre-pandemic times and the shift to the suburbs continues, larger units are expected to continue outperforming studios. Alright guys, that's it for this month's update. If you enjoyed this video, make sure you leave a like, click the subscribe button, as well as the notification bell next to that, to continue to learn more about multifamily real estate. I'm super excited to share with everyone our upcoming conference, the Hawaii Millionaire Mindset Conference, The Blueprint. Come join top industry leaders for motivation, training, and lots of networking. This will be happening here in beautiful Ko'olina, July 21st, 24th, 2022. Early bird specials are happening now, so if you want the absolute best pricing, go to millionairesmindsetblueprint.com to find out more. I'll leave the link in the description below. See you in the next video.